Is AT&T a good stock to buy now? Welcome to Global Value. Today we're performing a fundamental analysis of AT&T stock using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what AT&T is worth in today's stock market. Plus, I'll share 2 special bonuses that could be the deciding safety factors when adding AT&T stock to your portfolio. Right now, AT&T trades for $19.49 per share. In its last day of trading, it's exactly flat. Since August of 2023, AT&T stock is up 38% and it's crushed the market over this time. In the last 5 years, however, it's a different story, with the company's stock price being down 48%. In the past decade, AT&T is also down 45%. And since the global financial crisis, in the last 20 years, the company has declined by 1% annually. Thankfully, there's more for shareholders. Right now, AT&T pays a big market-beating 5.69% dividend yield. These returns are added back to their stock, and AT&T has gains for shareholders. Today, AT&T trades 50 cents below its 52-week high. This comes as the company's $5 above their 52-week low. And how big is AT&T? As one of the world's largest wireless companies, they have a $140 billion market cap. Plus, they use a ton of debt and they have a $302 billion enterprise value. Getting started with our first metric, we want AT&T's average returns on capital to be greater than 14%. Returns on capital tell us how much value a company can create. Think of it like your form when you're in the gym lifting weights. You want great form and companies want to create great value. For AT&T, they have increased their returns slightly over this time, growing these from 6% in 2019 to 7.5% in 2023. Still, these returns are around average, coming in at 7.3% in a given year. A normal business earns just about this, which is less than half of the benchmark we wanted. This means it's an X for AT&T. Now, what does the company really do? The wireless business contributes nearly 70% of AT&T's sales. The firm is the 3rd largest U.S. wireless carrier, connecting 72 million postpaid and 17 million prepaid phone customers. Fixed-line enterprise services, which accounts for around 16% of sales, includes internet access, private networking, security, voice, and wholesale network capacity. Residential fixed-line services are around 11% of sales. These primarily consist of broadband internet access serving 14 million customers. AT&T also has a sizable presence in Mexico with 23 million customers, but this business only accounts for 4% of sales. The firm still holds a 70% equity stake in satellite television provider DirecTV, but it doesn't consolidate this business in its financial statements. Next, we want to see if AT&T is growing. In metric number 2, we want sales, earnings, and free cash flow growth. Over this time, AT&T sales have come down each and every year. Together, these have dropped by 33%. This does consider that the company spun off Warner Brothers, which was merged with Discovery to create the new standalone company. At the same time that AT&T sales have shrunk by 1/3, their earnings are also down by 9%. Even worse than that, their free cash flows are down 28% for the business. All 3 of these are down, and AT&T is a shrinking company. It's an X on our second metric. Now, who owns AT&T? Today, there are 3 super investors with holdings in the company, and this is led by Bill Miller, who has 7.5% of his portfolio invested in AT&T. Miller started buying shares of AT&T stock in the middle of 2023. He's continued to add, and since then his holdings are up by more than 25%. In our third metric, we want to see earnings per share growth. This looks at AT&T from the view of an individual shareholder. In this time, their earnings have been very lumpy year to year, and they've been negative in both 2020 and 2022. While it looks like these have grown from $1.89 in 2019 to $1.97 in 2023, in reality, AT&T's earnings per share have fallen in 2024 and they're down to $1.74. These are down over this time, and it's an X on our third metric for AT&T. So far, things aren't looking so hot, but the company may surprise us and turn it around in the second half of our analysis. Next, we want something similar but even more important. In metric number 4, we want free cash flow per share growth. AT&T's free cash flows have been much more stable than their earnings, which were hit by both restructuring and some asset write-downs over this time. Still, though, their free cash flows have been declining since 2020. Even though the company's repurchased 2% of their shares, that doesn't offset this, and it's another X on metric number 4. This is not great to see, as free cash flow is truly the lifeblood of a business. But can AT&T's cash flows cover their dividend? Let's look at that next. Right now, AT&T pays a huge market-beating 5.7% dividend yield. In our first bonus, we want this dividend to be covered by their free cash flows. Even though their cash flows are down over this time, they've managed to support their dividend. This is the result of the company slashing their dividend in 2022. In all 5 of the last years, AT&T has been able to support this, and they've kept this dividend a lot lower than it was prior to 2021. This is supported today, which is what we wanted, making it our first check of the day on AT&T's dividend bonus. Next, let's look at their balance sheet. Wonderful companies can grow, earn high returns, and don't need a lot of debt. AT&T is off on all of those marks. The business has an incredible amount of fixed assets that they support by leveraging these very highly. This means in some ways, AT&T almost functions like a real estate company. They have very high amounts of debt, only rivaled by their peer Verizon. We do want to give them credit that they've done work to reduce their debt over this time, especially as their cash flows have come down. They've decreased their net debt from $176 billion in 2019 to $154 billion at the end of 2023. Today, this comes in at $146 billion. In the last 5 years, AT&T has brought in $117 billion of free cash flow. While that's absolutely massive, it doesn't fully cover their debt loads. Because of this, it's an X on metric number 5 for AT&T. The long-term capital structure of this business is something you have to look into if you're interested in the company. But let's look at the short term too. Warren Buffett's teacher and the father of value investing, Ben Graham, wanted to see a current ratio greater than 1.5 times if you're choosing individual stocks. AT&T's only been at this mark once, and that was in 2021. Today, their current ratio is under 0.7 times. There are some structural reasons in this business why this may not be as much of a concern, but given their very high debt loads, it is something you want to pay attention to. This is an X on our safety bonus, and again, something you want to watch out for. Now, what is AT&T worth? The big metric of them all, metric number 6, is also our first valuation. We want AT&T's average free cash flows divided by their enterprise value to give us a yield greater than 5%. This matches the historical yield from the S&P 500 and is bigger than the 10-year Treasury. Right now, AT&T has a $302 billion enterprise value. Enterprise value helps us look at the company more like a private business by adding their net debt and their market cap together. In an average year over this time, they bring in $23.4 billion of free cash flow. When we divide those cash flows by their enterprise value, it gives us a 7.7% average yield. In the last 3 years, they have a 5.9% yield, and in their last 12 months, they brought in $21 billion of free cash flow and have a 6.9% current free cash flow yield. Surprise, surprise, all 3 of these are higher than the benchmark we wanted, and it's a check on our valuation for AT&T. Now, don't just run out and go buy the business. We still have 2 more valuations to look at before we get to their fair value. AT&T might be a melting ice cube, but still, it could possibly be a good investment. That's why next we want to use a DCF model to grow their cash flows into the future. We'll start with an average of their free cash flows and use assumptions based on their history to grow them into the future. Let's assume AT&T grows their cash flows at 4% in each of the next 10 years. Then in the following decade, we'll assume this growth slows to 3% annually. We're also going to add in the company's tangible book value to estimate their net worth. Let's say we wanted a market-beating 15% rate of return, which is the same return Warren Buffett looks for. Then from today's valuations, that only gives a tiny $7 fair value, much lower than their stock price. Keep in mind though, they haven't been that predictable in their past, and this may be harder to judge going forward. Very crudely, AT&T trades higher on a price-to-sales ratio than they have in the past decade. During that time, they've underperformed the market. Still, roughest of all, they trade at exactly their 10-year median EV to EBITDA. The decline in their business in recent years is why our third valuation comes in at $17 per share, just slightly down from their current stock price. Historically, AT&T's been a cyclical stock, peaking and declining during the dot-com and telecom bubble back in the late 90s. Then they also peaked prior to the global financial crisis. Since around the middle of the 2010s, their stock has been down. Now, Warren Buffett likes the numbers, but it's the qualities of a company that he truly makes his investments based on. Why don't we learn what these are for AT&T through a long and a short thesis? We'll start with a long thesis first. Number 1, following a period of investment, AT&T will hold a nationwide 5G wireless network with deep spectrum behind it, and a fiber network capable of reaching nearly 1/4 of the United States. Number 2, AT&T has the scale to remain a strong wireless competitor over the long term. With 3 dominant carriers, industry pricing should be more rational going forward. And number 3, combining wireless and fixed-line networks with new technologies and deep expertise makes AT&T a force in enterprise services. But things aren't all positives. Let's look at a short thesis as well. Number 1, the cost of maintaining dominance in the wireless industry by controlling spectrum has been exceptionally high over the years. AT&T has spent $40 billion over the past 3 years for licenses with few prospects for incremental revenue. Number 2, advancing technology will eventually swamp AT&T's wireless business. This enables a host of firms to enter the market, further commoditizing this service. And number 3, AT&T's massive debt load will catch up with it. The firm carries far higher leverage than it has historically, and its dividend payout ratio, even though it's been cut, remains high. Legal liabilities could be an additional burden. Now let's put everything together for AT&T. In our fundamental review, we learned the company goes 1 for 6 on the Select 6 analysis. AT&T's cash flows historically and today look attractive compared to their enterprise value. Still, the company has massive amounts of debt that they have been cutting in the past 5 years. They've also repurchased a very slight amount of their shares, and they've right-sized their dividend for shareholders. But that comes as the company looks more and more like a melting ice cube. Their sales have been cut by a third, and their earnings and free cash flows are both down at almost similar rates. On top of this, they earn just normal, mediocre returns on capital. With more spending going into the business for 5G and increased competition, things could be even harder for AT&T in the future. Remember, this isn't financial advice. When we put their qualities and their numbers together, today a fair value for AT&T looks to be around $17.20 per share. That's down slightly from their current stock price, and AT&T looks to be around fairly valued. To find undervalued stocks, check out our Patreon in the description for free, and support the channel if you're interested.